Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Key Financial Regulations. Financial regulations play a pivotal role in maintaining the stability and integrity of financial systems worldwide. These regulations are designed to protect consumers, ensure fair markets, and mitigate systemic risks, all of which are essential components of effective risk governance. Key financial regulations have evolved over time, often in response to financial crises and changing market dynamics. This lesson will delve into several cornerstone financial regulations, their historical context, and their implications for risk governance. The Dodd-Frank Wall Street Reform and Consumer Protection Act, commonly known as Dodd-Frank, is a significant piece of legislation enacted in the United States in response to the 2008 financial crisis. This act aims to reduce risks in the financial system, increase transparency, and protect consumers from abusive financial practices. One of the critical components of Dodd-Frank is the creation of the Financial Stability Oversight Council, which is tasked with identifying and addressing systemic risks posed by large, interconnected financial institutions. The Volcker Rule, another crucial element of Dodd-Frank, restricts banks from engaging in proprietary trading and limits their investments in hedge funds and private equity. This rule is intended to separate commercial banking activities from high-risk investment activities, thereby reducing the likelihood of bank failures and protecting consumers' deposits. Basel Accords, developed by the Basel Committee on Banking Supervision, are a series of international banking regulations that aim to strengthen the regulation, supervision, and risk management of banks. Basel I, introduced in 1988, established minimum capital requirements for banks based on their risk-weighted assets. Basel II, introduced in 2004, refined these requirements and introduced a more sophisticated risk assessment framework, including the three pillars of minimum capital requirements, supervisory review, and market discipline. Basel III, developed in the aftermath of the 2008 financial crisis, further enhanced these regulations by increasing capital requirements, introducing a leverage ratio to constrain excessive borrowing, and implementing liquidity requirements to ensure that banks have sufficient high-quality liquid assets to withstand periods of financial stress. The Sarbanes-Oxley Act of 2002, another landmark financial regulation, was enacted in response to a series of high-profile corporate scandals, including Enron and WorldCom. SOX aims to improve corporate governance and restore investor confidence by enhancing the accuracy and reliability of corporate disclosures. Key provisions of SOX include the establishment of the Public Company Accounting Oversight Board to oversee the audits of public companies, stricter requirements for financial reporting and internal controls, and increased penalties for corporate fraud. SOX has significantly impacted the risk management practices of publicly traded companies, requiring them to implement robust internal control systems and conduct regular assessments of their financial reporting processes. The European Union's General Data Protection Regulation, which came into effect in 2018, represents a comprehensive regulatory framework for data protection and privacy. Although not a financial regulation per se, GDPR has significant implications for financial institutions, particularly in terms of managing the risks associated with data breaches and ensuring compliance with stringent data protection requirements. GDPR mandates that organizations implement appropriate technical and organizational measures to protect personal data, report data breaches within 72 hours, and ensure transparency in data processing activities. Non-compliance with GDPR can result in severe financial penalties, underscoring the importance of robust data governance and risk management practices in the financial sector. Financial Action Task Force is an intergovernmental body established in 1989 to combat money laundering, terrorist financing, and other related threats to the integrity of the international financial system. FATF sets global standards and promotes the effective implementation of legal, regulatory, and operational measures to combat these financial crimes. The FATF recommendations, updated regularly to address emerging risks, provide a comprehensive framework for countries to adopt and implement measures to prevent, detect, and prosecute financial crimes. Compliance with FATF standards is critical for financial institutions, as failure to do so can result in reputational damage, legal penalties, and increased regulatory scrutiny. The financial regulations discussed herein are instrumental in shaping the landscape of risk governance by establishing frameworks that promote transparency, accountability, and stability in the financial system. The Dodd-Frank Act, through mechanisms such as the FSOC and the Volcker Rule, addresses systemic risks and aims to prevent the recurrence of financial crises. The Basel Accords provide a global standard for capital adequacy and risk management, ensuring that banks maintain sufficient capital buffers to absorb potential losses. The Sarbanes-Oxley Act strengthens corporate governance and financial reporting, thereby enhancing investor confidence and reducing the risk of corporate fraud. GDPR underscores the importance of data protection and privacy, compelling financial institutions to adopt stringent data governance practices. The FATF recommendations set international standards for combating financial crimes, safeguarding the integrity of the financial system. In conclusion, key financial regulations are essential tools for effective risk governance, providing the necessary frameworks to manage and mitigate risks in the financial system. These regulations not only protect consumers and investors, but also promote the stability and integrity of financial markets. As the financial landscape continues to evolve, ongoing regulatory reforms and enhancements will be necessary to address emerging risks and ensure the resilience of the financial system. Financial professionals, particularly those pursuing the Associate Professional Risk Manager designation, must stay informed about these regulations and their implications to effectively navigate the complexities of risk governance and financial regulation. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UExcel, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.